Welcome to Accounting with Audra. In this video, I'm going to provide a basic understanding of IRC Section 951 Cap A, more notably known as the Global Intangible Low-taxed Income, or the GILTI provision. This provision was added to the Internal Revenue Code as part of the TCJA, signed into law at the end of 2017. Before we get into this rule, let's take a step back to better understand Congress's intent when they added this provision to the code. Initially, when U.S. companies wanted to do business abroad, they would ship goods from the U.S. to foreign countries, or they'd send U.S. employees to provide services. As companies expanded, many began setting up physical presence in foreign jurisdictions by legally incorporating their subsidiaries of the U.S. parent company. With the tax laws and tax rates being vastly different between countries, eventually additional migration of items like U.S. intellectual property and other assets occurred to the extent it provided favorable tax outcomes. Congress in turn passed some additional tax laws known as the anti-defferal rules. These rules, most notably the Subpart F rules under IRC Section 951 and investment in U.S. property under 956, resulted in certain foreign operations of a U.S. business being subject to U.S. tax, even if the income of those operations had not yet been repatriated back to the U.S. Please see my separate videos on Subpart F income for details on how the Sub F provisions work. This video is going to focus on how the third and most recently enacted anti-deferral provision, GILTI, works. 951 Cap A says that a U.S. shareholder of any CFC shall include in income such shareholders GILTI for the taxable year. So, let's say a U.S. shareholder has two foreign subsidiaries in country Y and X, and both are wholly owned CFCs. At first glance, it looks as if the provisions would apply to either CFC with intangible property and or a CFC located in a very low-taxed jurisdiction. However, neither of those characteristics are required for this provision to actually apply. Specifically, the provision states that the term GILTI means the excess of such shareholders' net CFC tested income for such taxable year over such shareholders' net deemed intangible income return for such taxable year. So what does that mean? Let's walk through step by step what is meant by tested income and what is meant by net deemed intangible income return, and then we'll understand how those items may create a tax liability for U.S. companies with foreign subsidiaries. We'll use the base structure just explained and walk through essentially 3 steps that help us determine our net GILTI inclusion. Those steps are: Step 1, to calculate their tested income and loss for the taxable year of each CFC. Step 2 is a step in which we net the tested income and loss of all the U.S. shareholders' CFCs together. And then finally, in step 3, to the extent that the net tested income exceeds a deemed intangible return on assets of those CFCs, we'll include that excess as a deemed dividend, also known as the GILTI inclusion, on the U.S. tax return of the U.S. shareholder. So in understanding this, let's start with step 1. So in step 1, we're going to calculate tested income and tested loss. First, we have to know what goes into tested income. So tested income starts with the gross income of the CFC. Then we reduce that gross income of the CFC by effectively connected income with the U.S. trade or business, any subpart F income we've determined under 951, foreign oil and gas income, dividends received from subsidiaries get excluded, and then finally, once we've figured out what income is left from there, we deduct properly allocable deductions to that income. So we'll take our expense pool and we'll allocate it among the various incomes. So let's use numbers to illustrate this. Let's assume CFC A has gross income of $8,000. CFC A also has dividends from subsidiaries of $500, cost of goods sold of $1,200, other expenses of $300, interest expense of $200, and taxes of $200, getting to a total earnings and profits amount of $2,600. We're also going to assume that CFCA has no effectively connected income, and a quarter of its gross income is foreign-based company sales income, so in other words, Subpart F, and a quarter of the cost of goods sold and taxes at CFCA are attributable to that foreign-based company sales income. Looking at CFCB, CFCB has gross income of $2,000, cost of goods sold of $1,600, and other expenses of $700, and CFCB pays no taxes. This gives CFCB total E&P or loss of $300. Furthermore, CFCB has no effectively connected income or Subpart F. Looking at A has gross income of $8,000, but we just said a quarter of that gross income is foreign-based company sales income. So what is going to go into the tested income group is $6,000. That's $8,000 minus 1/4 or $2,000. Additionally, the cost of goods sold of $1,200 is going to be reduced by a quarter because a quarter of that cost of goods sold is attributable to Subpart F income. Dividends from subs is not going to be included. It's going to be excluded from our tested income calc under the provisions. Our interest and other expenses, it totals $500, and none of those expenses are attributable to our foreign-based company sales income. And then our taxes, a quarter of those are attributable to foreign-based company sales income, so 150 are attributable to our tested income. This gives us a tested income for CFCA of $4,450, very different than the $2,600 of total E&P that we had computed. For CFCB, we have a tested loss of $300. There's no dividend from subs, no Subpart F income, no ECI, and all of the expenses that are given here are deemed attributable to the gross income generated at CFCB. So CFCB has a tested loss. Now what we could do is move into Part 2. And Part 2 says we're going to net the tested income and loss of all of the U.S. shareholder CFCs together. So again, looking at our numbers, we will start with the fact that we have CFCA with tested income of $4,450 and CFCB with a tested loss of $300. Netted together, we get an aggregate of net tested income of $4,150. Finally, after computing our tested income, tested loss, and aggregating them together, we can move on to step 3, which says that to the extent net tested income exceeds a deemed intangible return on assets, we're going to include that excess into our U.S. income. So what is a deemed intangible return on assets? The deemed intangible return is 10% of qualified business investment assets minus interest expense. These are the assets of the CFC less interest expense at the CFC. Qualified business investment assets are essentially assets that are used in the trade or business of that CFC. They generate tested income and they're depreciable under IRC Section 167. This is really important because assets that are used to generate, for example, Subpart F income or effectively connected income of a U.S. trade or business should not be included in your qualified business investment assets for this calculation. So you have to look to the underlying assets and the income to which they generate and apportion them to the extent they need to be apportioned. In this instance, we're going to say CFCA has tangible assets of $15,000 and CFCB has tangible assets of $30,000. In both instances, all of the tangible assets here are used in the trade or business. They do generate the income and they're depreciable under IRC Section 167. So even CFCA, even though it has foreign-based company income, we're saying that that income, these assets do not give rise to that income. Okay. Notice how the rule says generates tested income. CFCB in this instance doesn't have tested income, so we're not allowed to include the tangible assets of CFCB in our calculation. In other words, we can't reduce our inclusion by assets associated with a tested loss company. Using the math from our equation, if we have 10% of just the tangible assets from A, that's 10% of $15,000 or $1,500, less our interest expense. Looking back at the original problem, our interest expense was $200. So we will reduce that by our interest expense of CFCA. This gives us a deemed intangible return on assets of $1,300. So now what we'll do is we'll take our original inclusion, we had a net tested income of $4,150, and we're going to reduce that by that net deemed intangible return of $1,300. This gives us a deemed intangible inclusion of $2,850. Once we have our deemed intangible inclusion, we're not entirely done because there's a couple of key points that we have to consider in doing this calculation. So the first is the Section 250 deduction. This is another section of the code. It relates to foreign-derived intangible income, but it also relates to GILTI income. And that section of the code says that to the extent you have a GILTI inclusion, you can reduce that amount by 50% through kind of like a DRD, a dividends received deduction, but it's a deemed inclusion in this case. You can reduce both 50% of the GILTI amount as well as the Section 78 gross up to the extent you have one. In our situation here, we assume that taxes were deductible, not creditable. So in that case, we just have the ability to reduce our value by 50%. Also, this deduction is limited to taxable income. So if during the year you end up having a taxable income amount on the U.S. return less than your GILTI amount, you cannot take a deduction in excess of that and drive a larger loss for the year. Looking at our example again, our deemed inclusion was $2,850. We're going to then reduce that by the $250 deduction of 50%. So the total amount of GILTI subject to tax on the U.S. return is $1,425. Taking that by the statutory tax rate of 21% during the time of this video in 2021, we have an additional U.S. tax of $299. If we are eligible to take a foreign tax credit, we can further reduce this tax liability. One, we would need to adjust our initial calc to gross up our inclusion by any taxes paid in the foreign jurisdiction. And then we would do our calculation to potentially reduce this liability to something less than $299 or even down to $0. One other thing to keep in mind though is that the foreign tax credit with respect to the GILTI inclusion is a separate limitation basket that does not allow for unused credits to be carried forward or back. So it can't be blended with other types of income like Subpart F or branch income, and any excess credits in this basket are lost if they are not benefited from in the year that they're generated. So very important. I will have additional videos on foreign tax credit mechanics. Future modifications to the GILTI include one, a potential modification for country by country approach. That's what's being discussed currently in the House at the end of 2021. What was passed in legislation and initial enactment was the 250 deduction of 50% being reduced to 37.5% starting in 2025. That percentage is also being discussed currently and potentially may be decreased lower than 37.5% and sooner than in 2025. And then finally, there's discussion about whether the reduction of 10% of QBAI against the tested income amount being reduced to 5%, and a change to the foreign tax credit mechanics as they are for the GILTI basket. So to the extent there's some additional legislation passed, I will publish another video on those updates to this. Should be happening in the near future. And as always, if you are finding these videos useful or those I have on accounting, tax, and financial literacy, please consider subscribing to receive updates when new videos are posted.